we go. Welcome, everybody. Welcome. It is another Tactical Tuesday today. So I am Tiffany Young. For you, those of you that don't know me, I'm a co-founder of Investor Life. We help investors scale and grow their portfolios. So have an awesome topic tonight. If you haven't heard of Darren Mitchell or his book, Be the Bank, and his newest book, Infinite Banking for Real Estate Investors, those are definitely some books that all of us need to know about. He's going to run us through kind of the basics of what are in those books tonight. But it's great stuff, guys. So thanks for saying hi as you jump on. Good to see everybody. So I know some of you guys, especially our Igniteds, we had Darren come and present to you guys back quite a few months ago now. So you may not be familiar with it, but our Igniteds, I know, certainly are. So we're going to talk tonight about, what the wealthy do with their money versus what most of us do with our money, what we've been taught and trained, and how that works out. And then, how it works out if we do things just a little bit different. And the nice part about it is that it's not a whole lot different. It's just a little bit different. So, all right. Pros and cons of a concussion. Shelly, you poor thing. Welcome, and I hope you're feeling better. That's crazy. I saw that. Anyways, okay, so I am going to bring Darren and Christina on. There we go. Hey, guys. How's it going?
It's going fantastic. Thanks for having us.
Yeah, thanks for having us.
Yeah, thanks for being here. It's always a very exciting presentation when you're here, Darren. I know that. So what do you say? Should we just roll into it? Are you ready to go and tell us a little bit about who you are, what you do, tell us a little bit about your books, and then tell us about what we need to be expending our minds into as real estate investors.
Yeah, so Darren Mitchell, I founded a company called controlandcompound.com, and we basically help real estate investors and business owners with financial planning. So we're not the typical financial planning. We're the exact opposite of the typical financial planning. I'm also a real estate investor myself. I'm also a business owner. So everything I do is focused mostly, about 80% of my clients are real estate investors. So that's what we do. We operate coast to coast in Canada in every province except one. You can guess which one, but it doesn't matter tonight. And so we're virtual advisors dealing in every province in Canada, and we work pretty much exclusively with real estate investors. We focus on this infinite banking or high cash value life insurance and how it can help real estate investors and kind of show them what the wealthy do differently than most people.
Yeah, right on. And it's funny because I know we've heard those, buzzwords before, the wealthy do this and the wealthy do that and all that kind of stuff. But, when I read your book, I was actually like, yeah, that is different, because it's a buzzword, right? It's kind of industry lingo that you hear a lot. And so it kind of just goes over my head because I've heard it so much. But when I read the book and you give very good comparisons of, look, this is what we normally do with our money, and this is how it works out. Not bad. This is what banks do. This is what the wealthy do. This is what people that are financially savvy do with their money, and this is how it works out. It just such a world of difference. So, really glad to have you back. I know with your last presentation to our Ignited group, it was crazy, the buzz after. So, yeah. Guys, if you guys have any questions, as always, we'll invite you to throw them in the chat. Christina is a certified wealth planner. Is that what you said?
Wealth coach.
Wealth coach. So she will be answering questions for us as well. And Darren is a wealth of knowledge. I know that from the last time because even before we talked about having you on our show, I don't know how many questions there were, maybe 25 or so. I was like, so can I just grill you? And you're like, go for it. And I asked every question I had written down, a whole list of them, and got every answer that I was looking for. So that's not very often because I'm pretty inquisitive. So okay, so go ahead, throw your questions in the chat, guys. And we're going to just go ahead and tell us about what the basics are. You have some slides to share?
No, just our pretty face, just our pretty faces. Yeah, so thanks. So we really call our firm, like Christina and I and the rest of the staff, we're financial educators. I mean that's why we wrote the book. That's why I wrote the books. That's why we when we meet with you, it's there's no selling. Here's the education, and if people understand it, once they catch it, they can't uncatch it, is one of my mentors used to say. But this all started back 2008 when the market crashed, and I was a typical financial advisor, and I was like, holy crap, what do I do? Like, I just felt helpless because I wasn't in control. And that's kind of where I started studying what the wealthy did. And I traveled across North America, spent like a ton of my own money, but I learned what the wealthy were doing, and it was completely different than what the average investor was doing and what we were being told to do. And that really kind of led to the book and the second book and the really transformation of my business, and to get away from the traditional financial planning. Like, it's funny, the wealthier the person I deal with, the easier it is, right? Because most people go, oh no, I'm going to follow all the traditional financial advice, put my money in an RSP, and wait 35 years and hope it all works out, and I'm going to do this. Well, you talk to a rich person, well, how did they get rich? Well, they didn't get rich following the traditional financial planning. They got rich doing the stuff that rich people do to get wealthy. They invested in themselves. They invested in a business. They invested in real estate. So when you talk to a wealthy person, like, and you say something that, isn't the typical financial planning, like, they're all over it because they know typical financial planning. It's fine if you're a T4 9 to 5 person and you want to throw an extra $100. But, if you want to be a real estate investor and a business owner, it's, I don't believe traditional financial planning serves you at all.
Okay, so your book makes a really good case for that. Numbers, charts, graphs, really clear, easy to understand. Even I, as a non-numbers person, can understand that. So one thing that I really appreciated was that your book talks about the 4 ways that we make mistakes, and the four was it wealth killers?
Wealth destroyers, yeah.
Yeah, so let's talk about those. Can you tell us what those are? And to me, this is what makes the difference. When I think about life insurance, I do not think about an investment at all. I think about something that's going to sit there forever. I'm going to pay into it, and hopefully, when I pass, there will be something there to help my family cope. So we've had whole life insurance and term insurance since we were 19. So we that's always been just something that sits there and it's all good over there, and that's great. But you've got a whole different way of dealing with life insurance, where it actually, for one, does make it an investment. For 2, it makes it a tax-free investment. For 3, it allows you to use your money, even though it's in that investment, it allows you to use your money to invest in something else at the same time. So much power in using these whole life policies. We're going to ask you some more questions about that in a bit. How do they work? What are they called? Who administers them? All that kind of stuff. But before we get to that, why do you think, considering those wealth killers, why is it that you use these life insurance policies as this vehicle?
Sure. So the 4 wealth destroyers are taxes, fees, volatility, and spending. So, taxes number is without a doubt the number 1 wealth destroyer. I give an example in the book where, a great long lost relative put away 7,000 in change, invested it at 10%. 100 years later, it's worth $100 million, and you find out you're the sole beneficiary. And you're like, woo, $100 million. And then the lawyer tells you, oh, wait a minute, they paid 50% tax along the way, just on the growth. And now that $100 million shrunk to less than $1 million. And like, so people don't really get the impact of the long-term effect of tax. So that's the number 1 wealth destroyer. Is if you don't get a handle on tax, it's going to be pretty tough to win the game of wealth. And again, real estate does a good job of that in different ways. Your wealth appreciates in real estate, but really, tax is your number 1 wealth destroyer. So we eliminate that one.
So let's just talk about that for 1 sec, because I'll tell you again, something that absolutely blew my mind when I read the book was that just on the growth. So if they made, just 50% tax on the growth of the money every single year, took it from being what, 100 million down to $1 million?
Yeah, 100 million down to 1 million, just under 1 million. But yeah, $99 million effectively went to tax. But it's not that 99 million went to tax in one lump sum. It's every year it erodes your wealth, and then that lost opportunity cost is gone. So then it can't grow and snowball. I call compound interest a snowball. We want to roll that snowball for the next 50, 60 years. What most people do is the snowball erodes, or they smash it and start fresh. And tax is the biggest eroder of wealth. So everything, all the cash that we're putting in this cash value life insurance policy, it's going to grow for the rest of your life, completely tax-free forever.
Okay, so that's huge right there, right? Let's just say that we only used these whole life policies to, invest tax-free, and our gains are never taxed. Let's just say we just did that. We're already massively winning, but there's 3 other wealth killers that this also takes care of. So what's number 2?
Yeah. So number 2 is fees. And, I still can't believe this when I say it out loud, but the average mutual fund in Canada still charges a 2.2% MER, management expense ratio. And that is a huge wealth destroyer. Same thing. You can look at what your wealth would be with and without fees. Now, the investment management expenses on the funds we use, there's thousands of insurance products. There's only 4 specific products we can use. And these 4 specific products are specially designed to focus on cash value. They're all like 100 years old or longer, like the huge track records. They've never missed a dividend. They've always gone up. I joked the other day, I did the whatever 365 days times 150 some years. That's how many days in a row we've gone with whole life going up each and every day. It's not like the stock market. Some days go up, every day it goes up. So
okay, can I? So I'm very excited about this, as you see. But can I just say, just for those of you that are thinking what I was thinking when I first heard this, guys, this isn't like an insurance fund or index fund or whatever that Darren owns or that Darren's buddy owns. This is administered by some of the biggest insurance companies in Canada that have been around for, and I don't know if you give out names or not, Darren, and certainly you don't have to if that's proprietary to you, but that to me, again, gave so much cred to this whole thing. This isn't something that you've made up. This is something that's been there, but with thousands of products on the line, most of us don't know about these 4 products that we can use in our wealth journey. So, yeah.
Yeah, so the oldest one goes back to 1846. It's as old as Canada. So I mean, it's literally, and every single one never missed a year for a dividend. Like World War I, World War II, Depression, Spanish flu, .com, COVID, doesn't matter. People call me March 2020, and they're like, when COVID hit, and they're like, oh my God, the stock market's down. What's my whole life doing? And I'm like, going up in value every single day like it has since 1846. I don't know, worry about something else. But fees, so the investment management fees on this, those 4 funds are the only 4 sort of investment banking insurance products that are actually federally regulated, and the government actually regulates the fees. They came in years ago to protect the policy holders, because we actually own the fund, not the insurance company. So the fees range from like 0.12% to 0.18 for investment expenses. I'm oversimplifying here, but 2.2 versus 0.12 or 0.18, huge difference. So taxes and fees are the big one.
Which, by the way, I'll just say, if I hear a 2% fee, I'm like, that's not so bad. That's not so bad. Like, I think to myself, that's not so bad, until I read your book and I realized how that 2% fee, when it's affected every year and comes off your compounding that should be happening, I was like, oh my goodness, 2.2%, that's huge. So if the government is mandating that these companies can only charge us not 2.2%, but that 0.18 or whatever it is, again, massive difference. And I love how your book breaks those things down in graphs and charts. So
yeah, so the book has examples and all these. And then the third one would be volatility, and that's just the up and down, right? Like we look at we look after the last 25 years. Like volatility is a wealth destroyer, because you're buying high, and then all of a sudden it drops. People tend to buy high and sell low, but that volatility, it's a wealth destroyer long term, and there's examples of the book of that. And there's next to no volatility, not to get technical, but standard deviation, if you remember high school, kind of measures how much something varies. Standard deviation for most of these plans, the returns are around 1% versus the stock market of around 16. So the stock market volatile, this isn't volatile. You can't put something that you're going to invest in real estate in the next 1 to 4 or 5 years in the stock market, because if it drops 40% next quarter, or sorry, February 18th when it drops, you can't take advantage of that opportunity when it comes your way. So volatility would be number 3. And then the last one be the number 4 would be spending, right? So that's my snowball analogy I always use. What most people do is they think they're getting ahead, where they do one of two things. They go into debt and then they pay it off and end up at zero. They go into debt, pay it off, or they save and pay cash. And my save and pay cash analogy is you start with a snowball, you roll it, you get the base of a snowman, you're out with the kids, and then the kids smash it and you start with a new snowball. Well, that's when you save money, you kind of get to the good part of the compound interest curve, and then you smash it and you restart your compounding because you spent the money. Versus this, we're going to put money in, we're going to roll that snowball, and we're never going to stop rolling that snowball. We're going to roll it for the next 50, 60 years. And then, great, I did a private lend last year, get into private lending, and I had an opportunity to loan $100,000 at 14%. Well, I didn't smash the snowball and stop my compounding to take advantage of this opportunity. I went to my policy, or to the insurance company that manages my policy, and said, hey, I'd like $100,000 of your money. They gave me their money. My money stayed in the policy, continued to snowball for the rest of my life. They gave me their money, used my policy as collateral. I went out and loaned $100,000 at 14%. I paid roughly 4%. And my policy was completely unaffected. I literally multiplied money. So it was in the policy growing. It was in taking advantage of this real estate deal. And it was also multiplied in providing a death benefit for my family. Wasn't the focus. Cash was the focus, but it does come with a death benefit, and it does come with the ability for you to multiply money. So if you can eliminate taxes, fees, volatility, and the spending, the restarting the compounding, and then you could multiply money so it's in more than one place. I mean, that's what banks do, right? You deposit $100 and then they loan it out 3 or 4 or 5 or 8 times. Well, that's what we're doing. We're becoming a bank where you can deposit money, grow it tax-free forever, and use it. And when you use it, you do a real estate deal, it doesn't affect the growth of your policy because we're not cashing it out. We're multiplying those dollars.
Yeah, that's another powerful thing to it is that normally when you need money, well, you have to take it out of an investment to use it if you have it in one. Whereas this way so here's the thing that kind of for a while there was hard for me to understand. So, and I'm going to say this in case anyone else is as dense as I was, but basically your insurance policy is considered an asset, and so you're borrowing against it. So it's used as collateral. You're not taking out your money and using it. It's just secured against that. So it's still growing in that investment, but at the same time, you're able to take out that money and buy an investment property, let's say, or whatever you want to do with it. So that again was huge. And I have a bunch of questions coming in, Darren. So I wonder if we should hit some of them as we go.
Sure.
So first question, guys, is I've seen it a bunch of times. Sorry, I wasn't ignoring you. Is his first book. This is the one that blew my mind. Is Be the Bank. And just so you know, I heard about this strategy 20-some years ago, but it seemed convoluted and it seemed a little bit crazy and it seemed just, I don't know, I didn't love it. But when you read Darren's book, you really see the power of it. So Be the Bank is his first book. This is his second book. There we go. Infinite Banking for Real Estate Investors. So if you guys go to his website, controlandcompound.com, you'll be able to find all of this. And so that was first question. Second question, does it work with the Smith maneuver?
Yeah, that's a lot to get into tonight.
Yeah.
I like the Smith maneuver in the right scenario, so I'm not disparaging that. Smith maneuver is great if you're dealing with someone that knows what they're doing and stuff.
Totally.
A little too much to get into tonight on that.
Okay, so interesting. Okay, good to know. We have actually a couple of specific questions, so let me just see if name of the book. Can you also claim the internet expenses when doing the interest expenses, I think Robin meant, when doing a private lend?
Yeah, great question. Yeah, the short answer, yes. So when you get a loan, this is how you get a loan. So you call up the insurance company, you call our office, and we coordinate it for you, and you say, listen, I'd like to borrow money. And they're going to loan you 90% of your cash value, no questions asked. They're not going to ask you, is it a good investment? What is it for? How's your credit? When are you going to pay it back? How are you going to pay it back? Are you going to pay? They're just going to say yes. Now, why would they loan you 90%? Well, they're going to loan you 90%. Well, on a property, they're going to loan you 75 or 80. Why? Well, they have collateral, right? But your property could go up or down in value. Think of what they have for collateral. This cash value is guaranteed not to go backwards. Can't lose. It's guaranteed to go up every year. Has a 100+ track record of paying a dividend every year. The insurance company's going, we'll go to 90% because we're pretty confident this money's we're going to be there. And the only other thing that really screws up a loan, what happens if you die? Well, at the end of the day, there is a death benefit. So if you borrowed 40 grand and you get hit by a bus and they pay 500,000 death benefit, they're just going to subtract 40 grand from the death benefit and they'll deliver a check to your family for 460. So that's why they'll go to 90%. So the interest on that, let's say the interest is going to range from 3 to 5%, typically depending upon what company and what type of loan. That interest is tax deductible if you use it for business investment purposes. So if you put it in real estate, you do a private lend, you put it in the stock market, Bitcoin, all those things, it's tax deductible. If you go to Vegas and bet it all on black, not tax deductible. Okay, so it's got to be, it's no different than a typical loan in Canada. If it's used for business investment purposes to earn money, it's tax deductible. So yes, I bought condos with mine, and the interest is tax deductible, and private lend and land development, you name it, interest is tax deductible.
Awesome. Julie's asking, so in the book you talk about the WIM account being at 5%. Hers is at 10%. Is it still worth doing?
10% inside an insurance contract. It's that's not a whole life contract. If it's 10%, that's there's no whole life in Canada that I don't think there's any investment that pays that 10% on a guaranteed basis. Like this isn't meant to this isn't meant to be a better investment than your real estate let me back up. Let's do the private lend, right? So people will come to me and say, okay, well, Darren, why would I put it in here if I'm going to earn 4 or 5% tax free for the rest of my life when I can go do private lend and make 10, say, or I can go over here? And I'm like, okay, but I talk in the book about this. You're thinking like an or asset. Do I do the cash value life insurance policy or the private lending? Just like, do I do RRSPs or real estate, TFSAs or coaching? This is an and asset. Okay, that's the only and asset you'll ever own. Your money's going to be in the policy, and you're going to be able to also go do that 10% investment, don't go do that real estate. So why would you, if you can find a 10% investment, fantastic. Put it in the cash value first, get what you get in the cash value and the 10%, and now you're multiplying your dollars and you're multiplying your returns, and that's how you're going to get ahead financially.
Yeah, right on. Okay, so Julie's saying it's actually a universal life policy. So she says, what if my interest, maybe I said this wrong, what if my interest on my fund value to loan is 10%? Or is that a different product?
Yeah, universal life's a different product. Doesn't work for this concept because you don't have the all the advantages of whole life. It's years ago, universal life had a place. Today, it's just typically in a universal life, you're invested, not all the time, but you're invested in something more volatile, where there's some risk. This isn't like that. Again, separate conversation. Happy to chat about it. I have a UL policy from way back. They're not evil. It's just, it's way better. A whole life policy, participating whole life is way better if you want to do investments like real estate or start a business.
Yeah, awesome. And I'm not sure if you covered this. Is the interest comparable to a HELOC?
Yeah, so most of the insurance companies, there's something called, typically it's a policy loan in the early years until you get going. And most of the companies are around 4.45, give or take now. Some of them creep up to around 6, but most of them are around 4.45. And then we also have what we call bank loans, because the banks, if you think of it, banks love lending money. So now there's a bunch of online banks that will loan money on this, and the big five will loan too. But if you went in the big five banks and you asked them, about loaning on the insurance policy, they'd look at you like you were crazy. but I've talked to the people that do it at the big banks, but there's one or two people for the country. So, my bank actually offered me a loan of 2.95% on my insurance policies, but they weren't going to mess around till you get up pretty good in the six figures before they're going to mess around with the loan. So we usually say in the early years, we're going to use that somewhere around 4 to 5%. In the later years, once you build up some cash, yeah, we can go out and there's other places we can get loans, 3% ballpark and change. So there's options, but in the early years, and when you're doing real estate, it really doesn't matter. And I know that sounds crazy. It's like, well, of course, interest rates matter. Not if you're borrowing money for a couple of years to do a private lend or a down payment, and you're going to refinance the building in a couple of years. Whether you pay 3 or 4.5 on a $100,000 loan for the next year or two, and the interest is tax deductible, that's not the thing to focus on. The thing to focus on is I get to do the deal because I have control of my money, right?
There we go.
Control. Yeah. Like I used to think compound was the be all and end all, and name my company Control and Compound, control it and asset compound. But control is number one. Like to me, I looked at 2008 and the people that made $1 kajillion, they were the people that were in control of their money, right? They had the money to say, wow, I'm going to take advantage of an opportunity. My money isn't in the stock market, all in the real estate and stock market that plummeted. I have no access to cash. This never plummets. So, I call it my opportunity fund. If there's a dip in the stock market or real estate market or Bitcoin like there is now, I know I have access to money that isn't dipped that I can access and take advantage of those opportunities. So that's kind of my strategy.
Yeah. And I mean, it makes sense that if you can be using it for, something else. So just again, to clarify for those that might not be catching exactly what we're talking about, is that we're taking a loan against that policy. So yeah, we're paying interest on that loan. We're borrowing money against that policy. So yes, there's interest. But what Darren's saying, and what we know as investors, is that if we're paying, let's say, even 5% on that loan or whatever, we certainly can make more than 5% by putting it somewhere else, even on a standard private at 10 or 12 or whatever. Never mind doing a flip, never mind doing a burn, never mind in a long-term hold at 15% just from pay down. So, just different things like that. That's what he's talking about is, yes, you pay an interest rate on it, but yes, can we do better than that with that? Of course we can, right?
Sure. And just one more point on that, Tiffany, too. You got to remember what kind of loan it is. It's the best loan you'll ever have in your entire life. Okay. Yes, HELOC's a nice loan. Yeah. Mortgage is a nice loan. All those things are nice loans, but you got to picture this loan. It's uncallable, right? Real estate properties drop, your HELOC, your property value drops, you lose your job. Well, they can't call this. This is an uncallable loan. It's tax deductible if used for investment purpose, but it's also an unstructured loan. So you pay it back when you want, how you want, and if you want. So if, my private lend, I'm not making a payment. I'm just going to, June, I get my 14% gain. I'm going to pay off the loan then. You want to do a flip, a burst or strategy, whatever you want to do. You don't have to make a payment at all on this. You can wait 2 years, pay the whole loan off. Like, it's not a good strategy to take it and never make a payment for the next 30 years if you're 30 years old. But, there's no requirement. You pay it back when, how, and if you want, because you are in control. You're the bank.
Yeah, sweet. Hence the title, Be the Bank, I guess. Yeah, pretty awesome. Okay, what's the formula for the maximum amount that a person can inject into that policy in a certain year?
Yeah, so when we go to look at insurance policy, that's what Christine and I and our team, that's what we're experts at. But I mean, just in general terms, the insurance company looks at two things when they look to approve your application. They're going to look at medical information, because at the end of the day, this still is a life insurance policy. But you can own policy on spouses and kids and different stuff, but someone has to be insurable for this to happen. So they're going to look medically, and then they're going to look financially. And, typically we don't have a lot of problem financially, but the insurance company's not looking to insure somebody that's making $7,000 a year with a $6 million death benefit with $100,000 a year going in. They're going to say, wait a minute, something's off there. So it's got to be in relation to your income or your net worth. And real estate investors, we get a lot of flexibility on that because a lot of them tend to have equity in there and money tied up, not necessarily big incomes. But again, that's what we specialize is managing that process to say, great, this is how we're going to get this one approved. But financially, we don't tend to have a lot of problems unless, you're trying to put in more money than you have. And then they're going to assume you're, a Russian drug cartel and they're going to have questions.
Yeah. That might raise flags, anywhere on any given day. So
you can't deposit $100,000 a month in 5s and 20s.
Right. All right. That's good to know. Thanks for that tip there. Okay, so what's the ratio of the actual cash value amount that goes into the policy from the total amount of the payment?
Yeah. So great question. And there's unfortunately there's no answer like there is in some insurance products where this much goes in here. It's actuarially done every year. I will tell you, year one, sort of the hump year to get over. So year one, you're going to be underwater. I always say year one's like doing a renovation on a property. You're not going to be rich year one. You're going to be rich long term. Same with this type of policy. Year one, your cash value is going to be somewhere between 60 and 80%, depending upon your age of the product and how we set it up, what your goal is. Once we get to year 2 and 3, your cash value is going up by roughly what you're putting in. And then, year 2, 3, 4, again, depending upon the situation, you're growing by more than what you're putting in each year. Long term, we're looking for that, 3.5% to 5% tax free just on the cash. The death benefit grows as well. We design it to totally focus on the cash, but some of the growth is going to go towards the death benefit. Most of it will be driven towards the cash.
Nice. Yeah. So first year, and in your book, again, you have that as a chart or a graph or something that clarifies like that, the first year, if you're just going to come in and do it for a year and head out, don't even do it because you lose. But after that, it starts to compound, I guess.
Yeah. So we've got to put it in over a number of years. We can't do a lump sum and then be done. But year one's sort of the hump to get over, like a renovation. Then once you do that, you're basically growing by close to what you put in by then. And then long term, it's literally that. What's tax free 7,000 over 100 years at 100 million versus $1 million? Well, maybe not that $99 million spread, but that idea long term, it's just amazing. But the other thing is, even if you're a little underwater in the first couple of years, remember you're a money multiplier, right? So if you put in 60 and you have 50, well, if you can borrow 45 and you have 50 growing inside the policy and 45 growing outside the policy, well, you've got 95,000 in play. So if you understand the concept of being a money multiplier, really there's no bad years.
And that goes back to that, talking about being an asset. So it's not an if I can put my money here or I have to put it here. It's I can do both with it. I can put it in this, it's going to grow there. I can then also borrow it against it and put it into real estate or a private land or whatever I want to. And it will grow in both places.
Exactly. It's an and asset instead of an or asset. Yeah.
Perfect. So yes, Arthur, we are talking about whole life insurance. Is that what you guys call it, though? You call it something else, Darren, or Christina, maybe you can answer that.
Yeah, so we're talking about whole life insurance. That is what we call it. There's no surprise. It's definitely life insurance that we're working with, but it is a whole life product. So I know I saw a couple people in the comments still asking about the universal life and stuff. There are only 4 products that can work for the strategy, and they are called participating whole life products. And those are the ones, policies, and those are the ones that we need to use. So that's what we're speaking about today.
Yeah,
okay,
exactly. So I was going to say exactly right. So there's a bunch of whole life products. We can't use all of them. We can only use the participating whole life. And I talk about that in the book, but it's completely different, a regular whole life versus a participating whole life. That's the key, as Christina pointed out.
Awesome. So is there a point where you're too old to start this? And I'm appalled, Shelley, that you're asking this question, but let's do it. Is there a point that we would be too old to use it? Certainly her and I would not be, but anyone else maybe?
Well, we had an appointment with the 76-year-old today. Now in fairness, if you're, there's all kinds of different strategies that when you get to that age, typically we're dealing with somebody, late 50s, like mid 20s to late 50s. Once we cross a certain threshold, there's advantages for it, but purely as a cash value, we have a lot of people buying it on their kids or grandkids too. There's great opportunities there. But a policy on yourself, typically most people we deal with are between, 25 and 57, 58 for policy on themselves. And then after that, it would typically be a policy on some other family member if that strategy worked for them.
Perfect. Yeah. And Crystal's just saying, I read your book last week. I never hit the apply button. So Crystal, here's where you can apply now. Darren and Christina have put aside some time just for Fearless, just for Investor Life clients. So you can hit up this page and get in that thing, Crystal. It's awesome. Like it's we last time we told Darren, well, we got to get the Smith maneuver. We're working on that right now. That's finally done. It took us forever. And then we're coming back to you. So I'll be booking one of those with you too, Darren, 100%.
Great.
Okay, so let's get back to any questions. And if not, asking for a friend. I didn't see the first question. Do you use a cooperative insurance company for the policy so that there are dividends flowing into the policy as well?
I think what you mean by that is a mutual company, which mutual and participating. Yeah, those are the four companies we use. There's one actually that's what's called a mutual company, one a participating, but it's not the brand name cooperative. So if you're looking at the brand name cooperative insurance, no, that's not one we can use. But these insurance companies, the plans, people sometimes call them like a co-op, because the fund, like one of the companies we use, is a $12 billion fund. The fund, that participating whole life fund, it's not owned by the policyholders, it's not owned by the insurance company. It's owned by the policyholders. So in that sense, it's like a co-op, and that's kind of, Canada Life in 1846 was started with a bunch of farmers that got together and said, if one of us die, our family's in a lot of trouble. Why don't we pool our money, get together, and we'll kind of start a co-op, and we'll, if one of us died, then there's enough money for that family to survive. And that's really how Canada Life started, and that's evolved into this participating whole life. So it's a cooperative in that sense, but it's not the brand name cooperators.
Okay, so he's asking, I guess, too, about the mutual, maybe.
Yeah, so mutual, there's mutual and then three participating. We just put them all under that one umbrella of participating. But yeah, there's one mutual company in Canada. I own policies on them. I own policies on all four of the companies we deal with. We don't love anyone more than the other. It just depends upon your situations. They each have pros and cons depending upon what you're going on. But yeah, I like that mutual company too.
Awesome. Okay, so I was wanting to talk to you about how okay, so all of this, and I know we mentioned it quickly, but all of this, the wealth destroyers, the fees, you've got it all lined up in your book as to, how that breaks down if you were to not have those things, which this avenue gives to you. What we're kind of, we kind of glossed over is the fact that at the end of the day, you still have a life insurance policy.
Yeah.
So let's talk about that for a sec.
Yeah. So not everyone I talk to, there's a lot of people I talk to, especially people in the 20s, 30s, and 40s that are saying, I don't care about the death benefit. I don't care about the death benefit. I want the cash value. And I'm like, okay, well, it comes with a death benefit. Okay. It comes along for the ride. But, and there's, there's cool things. Like I started putting enough cash value in this that my focus was on cash value, but as a byproduct, it was also pumping out a pretty big death benefit to a point where I was able to actually go and eliminate my term insurance because I had a big enough death benefit because my dollar was doing more than one job, right? It was going in there, providing cash value for real estate, as well as providing a death benefit. But at the end of the day, you're going to have a death benefit in retirement, at death, hopefully in retirement, and that's completely tax-free. So what actually happens is the cash value when you die, if there's cash value, that turns into death benefit, life insurance, plus the life insurance, which pays out this total death benefit, we call it. And all of that flows out to your family, your beneficiaries, completely tax-free, and which is amazing. And as people get a little older, all of a sudden, legacy and helping people out seems a little bit more important. But not just that, but what it allows you, how it allows you to spend your money differently. So, I talk in the book about this. So, let's say you get a couple $1 million of death benefit. All right. Well, now you can think a little differently and say, okay, well, maybe I'm going to sell my real estate portfolio, when I'm 65 for $1 million or something, and I'm going to blow that money over the next, 10, 15, 20 years, and I'm going to die at 83 and there's next to nothing left. Well, you're kind of putting your spouse in a tough spot there. But who cares if there's a couple $1 million of death benefit? Because now the death benefit comes in, or the person that says at 70, I'm going to go get a line of credit on my paid off personal residence of 60 grand a year, use that 60 grand a year for my travel fund, and I die owing $500,000. Who cares if I have a $2 million death benefit? And it just goes on and on, the different ways death benefit can actually allow you to spend your money way more, not quite like a drunken sailor, but you can spend your money much more aggressively in retirement, knowing you have a death benefit, especially if you and your spouse both have a death benefit, then great. One of you are going to die first. I mean, I know we're all going to think we're going to be married for 80 years and die in the front porch swing together, but someone's going to die first.
Yeah. And you know what? I remember when I first read your book, whatever, in the last year, I remember thinking that when, that's exactly the benefit of having this, is that normally, like in my mind, even I think about, our assets versus our liabilities and all this stuff. And if something happened, is there enough to cover for everyone? My family's not stressing and all that kind of stuff. But in this case, then, for me, I always think of that with my insurance, my life insurance policy in there. Those numbers are always in there in my brain, and I'm counting on those. Whereas with you, with doing it this way, those numbers are in addition. They're on top of everything else. So, pretty.
Yeah, it's funny. I've never paid a death claim where the family goes, you know what? That's too much, Darren. That's too much. We don't need all that. But yeah, I mean, but back to refinancing too, right? My real estate portfolio, I'll refinance the heck out of that in retirement. Who cares if there's millions of dollars of death benefit? I'm still going to be able to leave it to the kids and pay the final taxes and do all that stuff. So, it just opens up tons of opportunity.
It does. Yeah. That's awesome. And I'll just kind of say, so a couple of people have asked, hey, who do you work with? What are the company's names? Now, I don't know if it's proprietary or not, but what I'll encourage you guys to do is just reach out to Darren.
Yeah, well, I just don't like saying on a podcast, you give us a call, so have a meeting. There's no secret. I mean, there's only four major companies that have participating whole life, one mutual, 3 participating. We're not hiding it. It's just, all of a sudden I got to go to compliance about everything if I start dropping names.
Well, not only that, but it is, lots of times these contacts are proprietary, and that's part of what you have worked so hard to build, is those contacts and those companies, and knowing those 4 out of the thousands that others don't know. So certainly we respect that some things are proprietary, and we're fine. So
this is all we do, right? So we focus on real estate investors and business owners, cash value life insurance, and how to implement the program in your life to make all the other things you do better. Right? We're not going to sell you a mutual fund and do all this stuff. We are experts at this. And when this is all we do each day, I'm sure you can go to the bank and your guy goes, oh, I can do that for you. Is he a real estate investor? Is he a business owner? Is he doing this every single day? No.
Yeah. Yeah. Love it. Julie's asking, what about if you have a personal business? Can I use so a limited business in any way?
Yeah, so I think you're asking, can you have a corporate-owned policy? Short answer is absolutely yes. I've got tons of corporate-owned policy clients. I have corporate-owned policies, personally owned policies. You can certainly use corporate money to buy a policy within the corporation. Again, just a kind of a checklist stuff to go through of how you set it up and which company you use, holding company, operating company. But short answer, absolutely. It tends to be where the bigger policies are, because it's really tax efficient money in there, and we can avoid tax. I don't want to say avoid tax. We can grow tax free, die tax free. Huge opportunity for a corporate policy if you have money corporately. If you have money personally, then it makes sense personally.
So, and that's one thing I meant to ask you too, was you're talking about Bank of Canada anyway, some big banks and stuff, and how they all own these policies. And I'm like, how do they own life insurance? They don't have lives. So
yeah, like you go to the States, and it's on my list of videos to do. But you go to the bank, I can say the American companies, Bank of America and Citibank and all these companies, some of these have like $20 billion of cash value life insurance. Billion,
Yeah.
20 billion. So they actually buy it
Right.
on all their executives as the lives insured, and then they build it up for the cash value. But banks, so what banks do is they put their money into cash value life insurance, exactly what we're talking about tonight. They leverage that and multiply their dollars, exactly what we're doing tonight, and loan that money out and multiply their dollars so it does more than one job, exactly what we're talking about tonight. But if you go to the bank, they're going to say, you should buy our mutual funds.
Right?
Yeah, the banks can't sell it. That's one big difference. They don't sell it, so they're buying their policies from someone else because they're not qualified to sell it.
and even the Canadian banks, like there's a couple Canadian banks that are fairly heavy in the U.S. market, so they're not up to that 20 billion, but there's some Canadian banks of the big five, that have $2, $3, $4 billion of cash value life insurance in their American operations because they have to disclose it. And there's actually a website you can go to and look up what each bank has in cash value life insurance in the U.S. Canada, there's no disclosure of that, but in the U.S. there is.
Gotcha. Crazy. Christina, what do you think? Is your credit score a factor in the qualification process for borrowing against your own policy?
It is not. When you go to ask for a policy loan, they ask you two questions. Do you want it direct deposited or a check sent out? And typically people say they want a direct deposit. So there is no credit score. They don't ask you what you're using your money for, where you're investing it. If it's a good investment, they are just going to deposit that money right into your account. That's an unstructured loan, no questions asked.
So you're pretty much like pre-approved because it's your own money and they know that they have a death benefit on it and there's so many different ways that they can collect on it. So you're pre-approved for your money, for money anytime. So really, for example, if we put, some money into this, deposit into one of these policies and then took out against it and invested in real estate, now we have two things going instead of just investing in real estate, which is one thing going great, but why wouldn't we just dump a bunch of money in here, then take that money and use it over here, and now we've got two things growing. And then they at the beginning of our visit here, they said that they just say yes. So isn't that insane for us as investors who usually have to jump through hoops and hoops to even get our own money sometimes?
I think, Tiffany, you could be a wealth coach, Tiffany, if you keep learning like that. That was a great explanation.
Well, it's very exciting. It's funny because I reread your book over the last few days here, and I'm just like, why am I not all over this again? Like, it's just, it's so awesome. So I know we talked about this briefly, but let's just cover it again because some people come and go into our feed. So is the death benefit tax-free to the beneficiaries? Does that mean that it's benefited? It benefit taxed first? Sorry. Okay, I don't know.
Yeah. So whole life in Canada is no different than all the other insurance in Canada. So I want, I don't want to say it's just whole life, but it's participating whole life, regular whole life, term insurance, all life insurance Canada, Section 148 of the Tax Act, tax-free. So all life insurance in Canada is completely tax-free.
Perfect. Todd, nice to see you, buddy. Infinite banking for real estate investors. That's the name of it. I would make this bigger if I knew how, but I don't. But if you go to, this is the feed, the controlandcompound.com/investorlife, and it's in there. So, there we go. Hang on. Let me get rid of this one. There we go. All right. So, how did I do that now? There we go. Any other questions? Oh, yeah, good one. Of course, coming from you, Tammy, you would have this question. What medical assessment screening required for qualification for the life?
Yes. So great question. I mean, COVID's been up and down for certain things, and it's been our business has done extremely well through COVID, and you're sometimes nervous to say that, but just the virtual online world, we were already there before COVID. There was that three week period when COVID first hit in 2020 that we thought we were out of business because they said, oh, we can't send nurses to go to your house to take blood and urine anymore because of COVID, and we're like, So one of the silver linings that actually came out of this is the insurance companies have tripled in some cases how much insurance we can qualify someone for just with questions over the phone. And that's typically a nurse call and asking some questions. So typically we don't see blood and urine or fluids, we call them. Sometimes there'll be a doctor's report where they'll go to your doctor and get a copy of the report. Now they reserve the right for blood and urine, and they do that in about 10% of the cases. But we don't, probably less than probably 5% now. So if something comes up in the questions, they may ask for blood and urine, but more probable would be they would say, okay, well, if this came up, we want to get a copy of that last report you had from your doctor. Or it could just be, men do a PSA test, or women do, the female test, and they go, great, can we just get a copy of that report? They'll send your doctor a check for a copy of the report. If it's something more serious, well, great. Again, they'll send your doctor a check. So your doctor gets paid for this, and they send a copy of the report in. And usually that's how they can make a decision. Anything that's really outstanding, we kind of talk about that up front in the first meeting to say, we have an underwriting consultant we use that, we can go to him and say, this is the situation, or even set up a phone call with the client and say, this is the situation. Are we spinning our wheels here if we apply? Or, we had one this morning, and it was, we had already kind of pre-screened him, because in the first meeting he said, well, I have this and this. We talked to the consultant. He goes, yeah, that'll be standard. Don't worry. So we can manage, but yeah, if you had cancer last month, you're not going to qualify.
So I have a friend who, last tried for life insurance 10 years ago. He's in his mid 50s. He had an aneurysm, a few years back now. I wonder if I sent you his details, would you kind of check in with your peep and see?
Yeah.
Awesome.
I mean, email, like typically a lot of those things are 5 years, right? They'll review it after 5 years, like a cancer, like a heart attack, a stroke. Those things are typically, 5 years clean, and then they'll evaluate. Now there might be a little rating, but ratings don't affect us like they do in the traditional insurance world, because so much of the deposit is going towards the cash, which isn't really affected by the rating. The portion that goes to the death benefit is going to be affected, but we've got kind of ways to diminish that.
Of course.
Typically the ones we get, oh, I'm on blood pressure or medication, or, I've got slight diabetes that's just controlled with diet. Well, great. If those things are controlled, that's not a problem. It's when something's out of control, or a major thing that's recent in the last 5 years, is where they sometimes don't like it. But, I bet you we have 1 in 30 policies declined, maybe 1 in 40. Christina, what do you think?
Yeah, not too many. We usually, by working and getting it, pre-screening it, and making sure, we'll definitely set expectations beforehand as well. So you'd know going in before if something was going to come up in that. But the majority of the time, we're going to get it put through.
Nice. That's awesome. Good odds. Okay, so as investors, now we've got like 5 minutes left, so maybe we can rapid fire through some of these here. As investors, how can we use this if we are not incorporated?
Yeah. So at the end of the day, everyone needs to save more money, right? That's one of the things all Canadians do, because if you don't have access to money, how can you take advantage of that opportunity when it comes along? This is just the most efficient way to save money. So if you don't have a corporation, you need to save money personally. And this is the most efficient place to save money. You build up a little nest egg in there, and you don't just sit on it. You take it and you multiply it. You keep growing it, and you start taking advantage of the opportunity at the same time.
Yeah, perfect. Okay, Margot's saying, or maybe I shouldn't have said who, a 63 and we're 64. Is there anything we can do in our corporation?
Yep. When we get to that age, we look at kind of slight alternatives. Something we call a joint last to die, where the insurance is on both lives, and that, 63 and 64, you're the equivalent of a 56-year-old together. So yes, we can do something at that age typically.
Nice. That's awesome. That's really awesome. Okay, let's see, what else do we got here? Screening and assessments. Tara, I think that was answered after you asked that. So I know who this is. I know who's asking this question, I bet.
I think I do too.
Yeah. And I'm assuming the answer is no, not Quebec, because most things are no, not Quebec. Is that right?
We can't talk to anyone that's in Quebec at the time. If they want to come visit us, or they're at another place and they want to chat, we can have a chat, but we just can't. We're not licensed to talk to someone that's going to be in Quebec. So we don't mess around with it.
Okay, cool. So if they're not in Quebec, you can deal with them.
We can certainly have a chat if they're outside the province.
All right. I love your I don't know what's the word for it. There is a word for it, Mr. Congeniality or whatever.
Christina's also the compliance officer. I got to be careful. It's
Okay, let me see here. Is it worth it to borrow a premium lump sum for a HELOC to get started? If so, what would that look like to make it worth it?
yeah, and that's more of a question that we would answer in a one-on-one. But the short answer, we see it every single day. Is it a good strategy long-term to do it year in and year out? No. Is it a short-term strategy to get jump started? Oftentimes, yeah, that makes sense. But again, we'd have to know the particulars.
Yeah, makes sense. Can you purchase policies in lump sums, so 10, 20, etc., or larger?
It's got to be over a few year period. Sometimes we can put a lump sum in year one and then a smaller amount year 2, 3, and 4. But we just can't put one payment in and be done. We've got to put it in at least over several years.
Okay.
But we can design it pretty aggressively depending on what exactly where your money is and how fast you want to get it in.
Okay. Yeah, I remember you talking about ours. Yeah. So Tara's saying the premiums are higher than term life, but how much higher?
Oh, it's not even close. It's like it's like buying a car versus buying a scooter, or like a skateboard. Like they're just different. They're different products, right? So we're in a term insurance. It's just pure death benefit. This is a place to save and store your wealth. So there's not an apples to apples comparison, but bottom line, if you are tight on dollars and you just need pure death benefit, this product isn't the answer. Go buy term insurance. If you only got $30 or $50 a month, buy as much term insurance as you can for that. That's going to cover your pure death benefit. But this is the term insurance is for death benefit. This is a saving, storing, wealth building strategy.
So what if I ask that question with saying, how much is it more than whole life? Because whole life is also way more than term, right? So, or I don't know what the terms are, but you know what I mean? Like the one that doesn't go away. So is it more expensive than that one as well? And would there be a comparison you can use?
No, again, okay. If you think of it, let's say you want to save $5,000 a year. Well, that's what the cost is. You're saving $5,000 a year. If it's 10,000, 20,000, 50,000, 100,000. So I don't think of it as a cost. This is just another place you're parking your wealth, right? When I put money into an investment property, that's not a cost. That's a place where I'm parking wealth. When I put money into a bank account, it's not a cost. I'm parking my wealth. When I put money into this cash value life insurance, it's not an expense like term. It's where I'm parking some of my wealth.
Okay. So now I remember this too from our first conversation. I had that confused as well. So it isn't like we're paying premiums. We're actually depositing into a policy. Yes?
Exactly. Yeah. Okay. So when you pay your car insurance, your home insurance, and your term insurance, that's an expense. That money's gone. That's on your expense, right? This is on your balance sheet, right? I have X amount of, I've got $80,000 of cash value. That's an asset like my bank account, like my equity, my properties, like my Bitcoin, whatever it is. That's just another asset. So it's not really a comparison to term. Term does great for just covering death benefit. Like it's a good product for that, but it's useless as far as growing wealth because there's no cash.
Yeah. Makes sense. And without getting political, are there risks if the Liberals change insurance regulations?
Not really. So every 25 years, they change the insurance rules in Canada. The last time they changed them was under Trudeau in 2017. I think it was 1982 before that. Every time they changed it and they actually made it better in 2017 for whole life. Some of the products got worse. But every time they've kind of done this in 25 years, typically they've grandfathered everyone that already had a policy under the old rules. Again, no promises, no guarantees, but 100 plus years. And politically, no one's going after insurance in Canada. You don't go after the poor widows and orphans, which is the perception of who gets those death benefits.
Right, of course. All right, last question real quick. We're over time now, and that's my fault, not yours. But would it make sense to use my RRSP to buy a policy?
Real tough one. Usually no, but depending upon if you can manage your income, sometimes business owners will stop taking an income from their corp, and there's strategies along that. But bottom line, you can't just roll an RSP into this without incurring the tax. So that's a more high level strategy, and it depends about all your other stuff going on.
Awesome. Well, Darren, rapid fire as always. So much information. Thank you so much. I'm sure you're going to get lots of people reaching out. It's something I'm definitely I'm going to be stalking you here because I got so re-excited about it over the weekend while I read your book. So, but yeah, thanks for all your information, always being so open. It's great. Christina, thank you for joining us. I know that you're helping Darren out a ton, and you're so organized. It's awesome.
Thanks so much for having us.
Yeah,
Appreciate
yeah.
it.
All right, so guys, next week we have I didn't write it down, but next week, one second.
I'll come again. If you don't
You'll
have
come
anyone,
again.
I'll come.
Oh, you might just have to, Darren. You just wait. I think it is Denise. Oh no, it's Sean Impey and Sean Sullivan. So mortgage brokers, what's going on in the market right now? What do we need to know? All that kind of stuff. We'll see all you Ignited over in laser session right away here. And thank you guys again for all of your knowledge and wisdom. Really appreciate it. And we'll be in touch.
Thank you.
Thank
Cheers,
Have a great night.
everyone.
Bye.
Bye.